In this video, we discuss an unprecedented series of low volatility days in the crypto market. Bitcoin still looks significantly weaker than the S&P 500 index. The energy crisis triggered by the war in the Middle East continues to gain momentum. And as usual, we'll review the weekly option strategy. Hello friends, you're on the Optionomics channel with your host, Roman Besedovsky. And today, as usual, we'll look at what trading opportunities there are for Bitcoin options. And what would I like to start with? It turns out that at the moment, what is happening in the Middle East, which we are all witnessing, has triggered a rather strong increase in oil prices in principle. It might seem like there's no oil involved, but in reality, there are far-reaching consequences to this. And so, in principle, in articles like these, which are published on English language websites, we can see the main points that are worth paying attention to. First of all, not only oil passes through the Hormuz Strait, but also gas. And here it is mentioned that 30% of the world's fertilizers as well. And it turns out that at the moment, all these factors are provoking not only that, the rise in gasoline prices and so on, but also a global increase in food prices. And it turns out that if this issue is not resolved in the near future, then this inflation, which is triggered by the rise in oil prices, among other things, and in general, if we look at the current price of Brent crude oil, for example, we can see that, yes, negotiations are ongoing, there seem to be some good news, but in reality, oil prices are moving sideways. So far, does the price of oil suggest that the negotiations are not leading to anything good? Because it turns out that before all of this started, oil was somewhere around $70 per barrel, and now accordingly, it's $110. So it turns out that these prices will eventually affect almost everything, because one way or another, everything in this world is delivered through freight transportation. For example, tankers transport oil, other ships carry food, and so on. And it turns out that if expenses for gasoline and other fuels double, this in turn triggers an increase in the price of everything else. And since the balance in this world is still quite fragile, it turns out that if a serious imbalance arises somewhere, it often provokes a rather significant crisis in other places. But at the same time, what do we see? We see that despite all this, the S&P 500 index has grown by 20% since the moment when those main fears appeared. The minimum, accordingly, was on March 31st. And since March 31st, the S&P index has risen by almost 20%. But since our main focus is still on Bitcoin, if we overlay the Bitcoin chart here as well, we can see that there is nothing close to such growth for Bitcoin. So if we also find March 31st here, then accordingly, we get the following. From March 31st, Bitcoin was at the level of 67,000. And accordingly, now it is 78. So in the best case, Bitcoin has gained 15%. But since Bitcoin itself is much more volatile than the S&P index, usually when the S&P grows by 20%, people often expect Bitcoin to grow by at least 50 to 70% and so on. But what do we see now? That all the bad news is mostly reflected in Bitcoin by a rather sharp drop, while on positive news it basically fails to grow properly. And if you look at this corridor, the one that existed, that is, I expected that during the rally we saw last week, Bitcoin could very well break through the 82 level and accordingly move somewhere into the 84 to 87 range. But that didn't happen. And by the end, it turns out of Friday's expiration, Bitcoin dropped back down to the 78,500 area. And if we look at how long this series of low volatility, weeks and days has lasted, including for Ethereum, something truly incredible is happening there. It turns out that looking at the weekly data, here's what we see. It's already been 55 weeks. There's been a streak where Bitcoin hasn't grown by at least 11% to its maximum. That is, this isn't even to the close, but to the maximum. So in fact, this is an absolute record. So if we take this period, has anything like this happened before? Since 2017, it hasn't happened even once. So right now, we're seeing a record streak without any upward movement, 55 weeks. And accordingly, here's what we have now. The longest streak without a downward move was 37 weeks. But the downward movement actually happened not that long ago. So if you look, it happened exactly 14 weeks ago. And for now, I'm not sure that this streak of no growing weeks will be broken. So far, it seems like the market still looks weak. And accordingly, there's a much higher chance that we'll see another candle with a drop of about 20 to 25%. And why do I think so? Because on the weekly chart, we've come pretty close to the moving averages, which are currently trending downward. The only thing I would really like, and this would give a much higher probability for a short, is when the moving averages actually get tested. I prefer when that happens. So if Bitcoin at least reached 87, and after that I considered a short, it would be much more effective. Although maybe this actually means that the market doesn't have enough strength yet, and that's why there's a pretty high probability it will drop down after this. And the second main cryptocurrency for us is Ethereum. it is also quite fascinating and very interesting to look at. So if we take a close look at the daily chart right here, we can clearly see that starting from April 14th, we have been stuck in a very narrow consolidated sideways range. Roughly from 2,252.9, the upper boundary can be drawn somewhere around here, up to 2,400. And as it turns out, this corridor was broken on Friday, Saturday. We finally broke downward. And if this movement develops further after such long, narrow consolidations, there is often a significant breakout. And why is the probability increasing right now? Because while we were still inside the corridor, it was reasonable to assume that the strength of the major seller and the major buyer were roughly equal. Now it turns out that the buyer is gradually starting to give way. And why does a strong breakout often happen in these situations? Because at the moment when the major buyer runs out of money, a void forms right here below this corridor. For example, he wanted to accumulate some volume at 2,250, was buying, and then accordingly he ran out of money. But since, apart from this buyer, there was probably hardly anyone else there, because usually markets are moved by major players, when his ability to support the price ends, the market can very easily drop through. There, I don't know, by 15 or 20%, and that's why, in my opinion, this probability now exists. For Ethereum, it turns out that reaching somewhere around the previous lows we had, which are at the 1,870 level, and for Bitcoin, accordingly, somewhere around 65,900, the probability increases. Why? Because that's exactly when this breakout downward from the range happened. But for Bitcoin, the market still looks stronger for now. That is, for example, I can assume that if a downward movement happens now, then, for instance, it will be more pronounced in other cryptocurrencies. Because in Bitcoin, we still have Michael Saylor, who continues to sell his preferred shares, and he's actually doing quite well with it. That is, he recently sold another 1.5 billion worth, and with this money, he can continue to support the price. And when this will end is not very clear. So it turns out he's buying an asset that, in fact, doesn't generate any profit, and he promises those who receive his preferred shares to pay them dividends. And with this borrowed money, they support the price. Honestly, I don't know if he'll have the strength to keep propping up Bitcoin until the end. But as I said before, this still looks more like a pyramid scheme, and sooner or later, I think this story won't lead to anything good, because historically, all similar stories have ended with quite serious consequences. And that's why I believe that this series of strong low weeks is already very close to its end. And by the way, I think there's a high probability that the sideways movement in oil prices, which we've been seeing, has also lasted from around the beginning of March up to now. It's been hovering from about 113 down to 93. I think that the breakout from the sideways trend in oil prices could coincide in general with a breakout in Bitcoin as well. And that's why, when there was a sudden spike, it was necessary to relieve some of the overbought conditions. So, while the moving averages were approaching, well, usually how is an overbought condition relieved? When the market moves far away from the moving averages, it needs some time for the averages to catch up. And often when the moving averages catch up and the market finds support on them again, that's when a new surge happens. And right now, that's exactly what we can observe. So first there was a spike to 118 and there was panic. Then it eased off a little, that overbought condition. And now there's actually a good chance that from the moving averages, we'll break through this, the 113 corridor upwards. So at the moment, since the trend is still upward, I'm more inclined to expect that the movement will continue in the same direction it's been going. And based on this, we'll be forming today's trade. And as usual, let's move on to our traditional scenario. So first, let's review the previous trade. The previous trade had no real chance of locking in any profit. So once again, I was buying volatility. I was betting that Bitcoin could either go above 84 or accordingly drop below 75. As you can see, the week turned out to be very low volatility. So what happened upward? We only moved up by 1.3% from the open, and there was a downward move of 3%. So if we look at the previous week, it's clear that the weekly range is getting narrower and narrower. For example, we had a strong 16% move at the beginning of February, and then there were weeks there. 6 to 8%, 1, 5, 7, 10, 7, 6, 4, 4, 8, 7, 4. And look at how narrow the weeks have been over the last 3 weeks. Here it's 1%, 1.3%. Here it's 5.05%. And here it turns out to be 1.3%. And from the option price chart, you can see that option prices continue to fall, meaning that last week a certain minimum in prices was formed. And now they've experienced a slight upward recovery, just as Bitcoin underwent a minor price correction, but overall we are holding steady at approximately the same valuation levels that were present at the specific moment when the Black Friday crash first occurred within the broader cryptocurrency market. And note that, according to the Delta Scoop chart, we can see a renewed rise in puts, meaning that fear is returning to the market. And another thing I noticed is that although it's not as obvious with Bitcoin, it's still worth mentioning that someone made a trade with 70 puts for June 26th, which means we have about a month and a half until June 26th. Someone bought 60 puts for June 26th. Yes, 80 calls were bought, but usually options that are close to the current price are sold, because if you look at the price distribution, most often the market either stays in place. That's why professional options traders usually sell the central strike. In other words, the market doesn't move anywhere at all, and usually they hedge with slightly more distant options. So if we see a trade going through on some far out of the money put, like the 70 or 60 strike, then most likely that's a bet that the price could actually go there. If we see a trade on a near the money option, then most likely that's a sale, because if the market doesn't end up going above 80, but you can make good money from selling that option. So last week I increased the risk on my trades for the week, and those options that I bought, they expired worthless. And my loss amounted to $1,800. I'm still continuing to buy volatility, even though the current drawdown is already quite unpleasant. And if you look at the chart, you can see that now I've almost lost all the profit that I made during the move to 60. But at the moment, my risks are higher than they were back then. That is, when I took that trade, in fact, that trade was made with a very small volume. So if you take a close look at the specific time when I was actually buying those assets, it turns out that it was back in February. During that particular trade, my overall level of risk was significantly lower than it is right now. And why was it lower? Because if you remember, those who watched my videos, I bought the 74 pots in an emergency situation. Back then, there was also a breakout from the sideways range. I bought them a bit earlier, and that's why I bought them in a smaller volume than usual. So in fact, the risk there was lower. Now, my total risk is about 1.5 to 2 times greater than it was during that move. If something similar happens now, I think the profit could very well be 15 times the risk. So if now I'm risking about 1.5 to 2%, I could get roughly 15 to about 30% profit net. If such a forecast comes true, that would be really great. But I also understand that anything can happen in the market, and it's quite possible that this sideways movement could continue for another 4 to 5 weeks. Although, as I have already shown you, it's clear that this streak has been going on for a very long time. And by the way, I also want to draw your attention to something. I also look at the same thing for Ethereum, and for Ethereum, I periodically check this kind of indicator. That is how long there hasn't been a movement of a certain percentage. Look, if I set it to 4%, you can see that the last 4% move in Ethereum was 34 days ago. And that's an absolute record. In the entire history of Ethereum, there has never been a time when for 34 days in a row, Ethereum didn't move even 4%. So for Ethereum, normal volatility means it can easily move at least 5%. For example, if you set it to 5% here, you can see that there's exactly the same record for 5% moves. So this series of low volatility days for Ethereum, it's somewhat similar to Bitcoin, and most likely even more so now. That is, while Bitcoin was still updating its highs, you can see that Ethereum here was rather under some kind of pressure. And here it encountered quite a serious seller. So for Bitcoin, we have a slightly more upward channel. Ethereum being a less liquid asset right now seems to indicate that we have a higher chance of moving further downward. Therefore, my current position will be more focused on the possibility of a decline. But I will take a small position for growth as well, because I see that there is still some unrealized growth potential left, up to around 87. Well, after which I also expect a decline. So it turns out that my forecast is that we could either go above 81, actually. That is, if we move up, I think we could break through that previous high, which was around 82,300, and reach exactly this resistance zone, which used to be support somewhere around 86. Downward, if the movement accelerates now, if this movement in oil continues, I think we could easily drop somewhere to around, well, at least 72. But in reality, again, if panic sets in, if a major buyer leaves, I think we could easily drop somewhere, say, to around 68. In fact, not even 68, but maybe a bit lower, to around 67, to those previous lows. Because I'm basing this on the idea that the movement could resemble the previous downward cycle, and back then we fell by about 22% in a week. So based on this, I will be forming my position. So it turns out that we take the data for the backtest. You see the last week moved by 0.7%. That's funny for Bitcoin, so we copy it into the backtester. And will form a position. It turns out that on the chart, the price of options, you can see that the prices are still very attractive for buying. By the way, this also suggests that it's still profitable to sell some in-the-money puts, but as I've already mentioned, that's because since 2020, Bitcoin has mostly been in a bull market. So it's more like he's recommending buying spot, since spot has mostly been rising during this period. So let's take a look at the prices. 81. The option costs us $385, and historically, according to backtesting, it shows $385. A 50% return with drawdowns does happen, and by the way, the win rate is actually quite high. To put that into perspective, a little more than 1 out of every 4 weeks actually demonstrated a level of growth that was significantly higher than that specific figure. Well, that is approximately a 4% increase, at least when we are specifically looking at the overall growth metrics for this period. And if we take the time to look a bit further at 182, then our maximum drawdown remains exactly the same at 225, whereas before it was 226. However, it is worth noting that it only experienced a very slight decrease overall. However, at the same time, the overall return drops quite significantly. And here, of course, is an interesting question, because there's a temptation to buy more distant ones in the hope that there will be a volatility spike, or to rely on the backtest and take those that are closer. I think I'll still go with the ones that are further out, because I want the overall options position to be larger to get more multiples in case volatility also spikes. So I'll take the 82 call options. I'll add them to the portfolio. And I'll also take... By the way, I also want to clarify that on Friday, when the corridor was broken, I had already used up 1% of the risk. That is, I bought 72 put options at $260 each, or $265. I can't remember exactly right now. I think it was $265. Just to remind you, my goal is to keep the risk per position for the week under 2%. So for example, if I now take 82 call options, let's say I take 2 of them, then my current risk will be $1,500. And honestly, I would probably prefer to have more options than that, because I believe that the chance of a decline is higher than the chance of growth. So in this position, it turns out to be 2 call options and 3 and 6 put options. I'll probably add a few more put options. 72 at the moment after volatility has dropped is probably a bit too far away now. So here there is potential profit. 77% with a drawdown of 7.8. But for example, 74 are of course much closer. But by the way, here's how it turns out for them. An 11.3 drawdown. Here it was 7.8. So the drawdown increases by a factor of 1.6 times, whereas the total net profit increases by a margin of only approximately 23%. It seems like the 72s are still more profitable. So if you expect the market to drop by at least 10%, the 72s could bring in more. And of course, after a series of losses, that's quite a dilemma. That is whether to buy the ones that are more likely or still go for those that have a better chance of good profit if the market falls sharply. Looking at the situation, I'll probably go with the statistical probabilities and historical data. Meaning I'll take a few more of the 72s to round out the strategy. So I'll establish a more significant position here. And I'll add a couple more options at the 140 level in the 72s to finish it off. For that, I need the market to correct by at least 10% so that they go into the money. So what does that mean? It means we get a chart like this. Right now, prices have gone up a little. And as for the risks, the risk comes out to $1,845. I guess I could add a few more call options, make it 2.5. By the way, it's interesting that since the market has still been more bullish, call options improve the backtest because the statistics favor the buyer more. So we end up with a chart like this. Here the risk is already $1,964, including commissions. And with this position, I plan to go into the next week. Let me remind you that if a strong impulse does occur, which I think is now more likely, after we finally manage to break below, I will partially lock in profits, because now the risk is already increasing, so this increased risk can be used to partially offset the losses that occurred during the previous drawdown. And as usual, I will write about all my trades and position management in my channel. You can subscribe via the link below. Well, friends, I'm going to proceed with this position. Of course, after such a series, I can say it's no longer comfortable, but I understand that in principle, this is quite normal for the market. That is, sometimes there are even longer streaks. I expect that formally, maybe for another 5 to 6 weeks, we'll just be moving sideways. Although, in my opinion, the current situation is developing very rapidly. I'm talking about geopolitics, and this energy crisis is already starting to have a significant impact on what's happening. Well, let's see what happens. See you next Sunday. Thank you for watching my video until the end. I'd appreciate it if you give it a like. If you have any questions about options, feel free to ask in the comments or on my resources via the link. And remember, this is not individual investment advice, and you make all trades at your own risk. Remember, if possible, don't risk more than 3 to 4% on a single trade in weekly options. For daily options, I actually recommend limiting yourself to a maximum of 2%. Thank you, friends. This was Roman Vesedovsky with you. See you again on the Aptonomika channel. Bye.